go. Okay, folks, I'm going to kick it off now. Thanks for joining. Appreciate your patience here. My name is RC, and I run the webinar and content programming here at BuildOps. And BuildOps is the only all-in-one business platform built exclusively for commercial contractors. And you can check us out over at buildops.com to learn a little bit more about that. So today we're talking about private equity in the mechanical industry and HVAC. And for a lot of folks, it's like a really exciting opportunity. For a lot of folks, it's complete mystery. So the goal of today is kind of cut through the mystery, bust some myths, and just give you some more information from folks who know what they're talking about. So whether or not you're actually planning to sell or not, I think this information that you're going to gather is going to really help you to understand how to build a stronger, more enduring, scalable business long-term, no matter what. So let's jump right into it. So I know your time is valuable. So Tito, David, Aaron, welcome. We're going to do some quick intros. As we do some quick intros, I'm going to pop open a poll for you. You'll see a couple polls popping up throughout the entire session. These just let us know a little bit more about how to gauge and how to change our conversation, make sure that we're talking to you in the right way, to make sure that we're really giving you the best amount of impact. So in a second, I'm going to kick off with the first poll, but I'll also start off with David, if you want to say a few words about yourself.
Sure. I appreciate you guys having me. David McCombie. I'm the founder and CEO of McCombie Group. We're a mid-market M&A advisory firm helping people sell their life's work at the best possible fit, price, and I'm also the author of a new book that came out called Selling Your Business with Confidence.
Awesome. And Aaron.
Nice to meet everyone, and thank you, David and Tito, for being here. I work at BuildOps. I work primarily with our private equity partners, and we've seen a massive growth in our customer base within the private equity partners that we work with. And I actually got introduced to David and Tito through an article that they posted about, private equity for the HVAC trade. So yeah, really excited to kind of lead the conversation here, and I'll kick it over to you, Tito.
Appreciate it. Thanks for having me. My name is Tito Gill. I'm a partner at McCombie Group. Like David McCombie said, we help middle market companies sell. We work across various industries, but we're pretty well versed on the HVAC space. So we're excited to hopefully shed some light and add significant value to you all. As far as background, my background's in finance, and I've been, either owning, operating, or investing in businesses since, shortly after college. So look forward to shedding some of that experience on you all as well.
Awesome. I want to call out one thing. Aaron mentioned an article that got him in his cross paths with Tito and David, and we'll be sharing that article. Might share it later in the Zoom call, but regardless, tomorrow in an email, we'll share the recording of this webinar, but also kind of addendum content like that article as well. So you'll get some of that in an email, so look out for that. Before I hand over the keys to Aaron, who is a lot more knowledgeable about this world than I am, I do want to call out one thing, Aaron. So we've got some poll results here, and 60% of folks on the call today have already been approached by PE firms. 40% are actively preparing to sell in the next few years. Thoughts about that?
Yeah, I think that's pretty on par with what we've seen. I know in my conversations, because I talk with both PE firms as well as our contractors. And typically, if you haven't been approached by PE, it's a little bit more rare, as David and Tito, I'm sure you guys have seen. But yeah, it's also cool to see that, there are people here that are, actively looking and preparing their business for a sale. I think that's a big piece of what we're going to go over, just because you guys have so much experience with preparing, sellers for that big sale. But would love your guys' thoughts on that as well.
Yeah, so there's about $1 trillion of what's called dry powder in this industry, meaning how much capital has been committed to investing that hasn't yet been deployed. So for the 40% that have not gotten a call, you will be getting a call soon. Not only is it a great industry that we'll talk about, but the capital is kind of on the sidelines waiting to be deployed. And we'll get into some of the details on what they look for, but good chance if you haven't gotten a call yet, you will very soon.
Yeah, but
Awesome.
before we go on, one more note of operations on my end. So this is very much a panel discussion. So you won't be seeing a bunch of slide decks or anything. It's going to be a bunch of folks talking about the things they know best and are most passionate about, back and forth. And part of that panel discussion is absolutely your involvement. So if you have any questions or comments or anything, please use a Q&A. I'll be sitting here very quietly, monitoring the Q&A, and I'll make sure to surface those questions to get these folks to answer them for you. So definitely, please, more than welcome. Please, definitely use your Q&As. And with that, I'm gonna shut my mouth and back away.
Appreciate it, RC. So we're gonna be going over kind of three main topic areas. Realistically, the conversation will be led by you guys, so we can bounce around. We don't have to stick to an agenda, but the three main areas we want to cover today are first off, why private equity is flocking to the trades. I think we've all seen this and we've, gotten the calls or we've seen a big push for this, but why now? Also some myth busting around, myths versus reality in the private equity space. Because, people have ideas and potentially misconceptions on what it is, how it operates. And lastly, we want to have you guys leave this conversation feeling more prepared for your business to create long-term value. So the first kind of question I would pose over to you, David, is, we've all seen it. The private equity interest in HVAC has exploded in the recent years. Why now, and what makes the trade such an attractive investment for private equity?
Yeah, absolutely. Just taking a real quick step back, just so that everybody understands the context. Private equity essentially is in the business of acquiring private businesses with the goal of generating investment returns. So essentially, it's an alternative to, fund manager investing in Apple and different stocks. They're doing this with the goal of achieving outsized financial returns. And most of them are getting their capital from pension funds and endowments and ultra high net worth individuals that exist out there. That's what's creating this $1 trillion of dry powder that Tito mentioned. Most private equity firms, particularly in the HVAC space, are pursuing a consolidation strategy. So what they're trying to do is essentially buy up and aggregate lots of smaller companies, and they're trying to take advantage of a phenomenon that currently exists in the markets, which is that bigger things have higher valuation multiples than smaller things. So what does a creative, entrepreneur do? They put lots of small things together, package it up, and sell it, and make the spread for the larger things. So I just wanted to level set with that in terms of how private equity is operating. And the reason that the trades, and in particular HVAC, is really attractive to these private equity firms is basically three main reasons. First and foremost is HVAC is a recession-resistant industry that's an essential service. And so ultimately that provides them a lot of comfort to be able to invest in it. But perhaps more importantly, it provides lenders comfort to lend towards it. And so lending is a critical component of private equity being able to participate, and in particular, to be able to stretch in terms of pricing in an opportunity. The second is it's a relatively fragmented industry. Yes, there's some large HVAC companies, but in general, if you look at it across the entire United States, the majority of technicians work within smaller HVAC companies. And this provides an opportunity for a lot of these consolidators to basically build a large regional or perhaps even national platform that can serve a large amount of customers. And then lastly is just the growth tailwinds. You've seen that HVAC as a category, particularly because a lot of the growth in the country has been in the South. HVAC as a service is growing at a much higher rate than the economy overall. So you put all those things together, and from their investor hat lens, HVAC is a very appealing industry to be invested in.
Yeah.
And to add to that a little bit, just to support it, 2019, there was roughly 25 national consolidators. There's north of 80 today. So I think when we look at resilience, whenever we reach hard times, that's kind of a moment to kind of prove how resilient something is. I think the COVID years really made this really attractive, right? Think about COVID years. Do you want the neighbors over? Probably not. Family, you know, grandma can come see the kids. AC repairman, come right in. I'll make you some lemonade and are you hungry? Right? So we don't want to be too uncomfortable these days, certainly not in, you know, the warmer climates. So not surprisingly, there was a big kind of jump in consolidators around that time because it really proved during, you know, one of the darkest times of this country how resilient the industry is and how valuable consumers feel about it.
Yeah. Yeah, a lot of our contractors that I've spoken with personally, they, in 2020, in 2021, they just keep growing at a pretty rapid pace. A big thing is, a lot of times I hear, we don't necessarily need more work, we need more skilled labor because the demand
Yeah.
for this business is so high. So yeah, I think you guys nailed it on the head there. Tito, I wanted to pose a question for you because
Yeah.
you've been on the M&A advisory side there. When a PE firm is like reaching out and let's say that they find a seller or an owner that has interest in selling, what's really the first thing when you like start to open up the hood? What is the first thing that PE firms look for when evaluating a business?
So if you're getting a random call, right, for the sake of conversation, first thing they're going to want to know, and they probably know because it's on their database, but they're going to want to talk about it is it residential versus commercial? That's going to appeal to different buyers for different reasons. Both are very marketable today. Um, some big players are doing both, but for the most part, should be an assumption if you're fielding a call that the buyer is going to be interested in one or the other. If it's on the residential side, immediately the first question they're probably going to ask is how much of the business is in new construction? So for the reasons David mentioned earlier, buyers are going to want predictability on revenue. So they're going to favor service revenue and install revenue over new construction to the point where if you're doing 10 million in sales and 2 million in new construction, they'll basically value those 2 million at zero and just value the remaining 8. So that dovetails into preparing for sale, and we can talk about that later. But for those that are kind of listening in, that's preparing for sale, that's something to keep in mind over the years as you're designing your marketing and your business to be more attractive for an exit. I think once they talk about new construction versus service and install, then they'll want a percentage of service versus install, with the preference being more towards service oriented. It'll never be 100-0, obviously. But if it's 90-10 in the other way, it's probably a little less attractive than if it was mostly on the service side. So because service is so valuable, they're going to it'll help to see a very robust kind of follow-up infrastructure, customer service support and things of that nature that lends itself to predictability on the servicing side.
Awesome. As we're going into this next section here, RC, can you pull up that next poll? Because a big piece of private equity is kind of the value add after and post acquisition, just because private equity returns look different now than it did, even a few years ago. And one thing that I wanted to see is kind of as you're looking at your business today, like what are some of the biggest challenges when it comes to scaling your business? I know I mentioned one about hiring and keeping skilled technicians. I'm assuming that one will probably be the resounding one, but kind of curious from your guys' perspective. As that poll is going up, I'll move in kind of into our next section here, kind of doing that myth busting around, private equity in HVAC. Tito, so we've seen a lot, and I've talked with a lot of contractors, that there's a common fear that when selling to private equity, it means you lose all control of your business. And these are businesses that, you put, 10s, 20 years into, and you are so proud of it, and it's something that you've put a lot of work into. As someone who's been through that process, what's the reality of that?
So it depends. And I think something that's really important when choosing who to sell to is fit. And when we represent a seller, it's up to them what offer they want to take ultimately. but we're very big on kind of educating them on some of the pitfalls of having misalignment with the buyer. So that's a big component of it. And I think part of this is driven by what the seller wants, and then kind of play matchmaker with the buyer that's willing to kind of accept that. And I'll give you an example. If you're selling in a fairly major city or around it, there's probably going to be a consolidator already, and there's probably going to be a platform business there already, meaning a pretty sizable one. So if the seller is saying, I'd rather kind of walk away, unlikely they can walk away day one, but certainly within a reasonable amount of time, call it 12 months, depending on many factors, they can. Not to get overly philosophical, but how do we define control there, right? At the end of the day, you're selling the asset. The buyers should and typically does listen to what you're saying because it's your business, you've ran it, but the buyer also has best practices, having 100 million, 200 million, 400 million in revenue. So there's going to be definitely some sort of convergence, and the buyer strategies are most likely going to prevail. But I think something key that we do talk to sellers about often is the emotional component of it. When I sold my company in 2019, I was a little bit on, I'm going to say, the extreme side. I had no emotional connection to my business at all. I'm a big cyclist. I have 3 bikes in my garage. I'm a lot more emotionally attached to my 3 bikes than I was to my business. For me, it was a vehicle. It was an asset. I took pride in it, but you sell it, you kind of move on to the next thing. I think that emotional component is really important. Again, not to get philosophical, but when we talk about control, that tends to be an emotional thing more than a practical thing. Because at the end of the day, you're selling it, and somebody has the right to improve it with collaboration. Usually as they please, not usually, always as they please, right? They're the buyer at the end of the day.
Yeah.
And so sometimes
David, I know you
to
have a lot
jump
to add
in,
to there. Yeah.
you know, the when you look at the different, buyers, you really need to first look within yourself and say, what do I want? And then, is there alignment in terms of where I want to go and where the buyer wants to go? Most buyers are very well intentioned. The issue is that they're not on the same page of where they want to go. And so what a lot of people fail to realize is when you sell your business, you're unlikely to just walk away clean from a financial standpoint. You're generally going to have ties with the buyer for a period of, generally years, whether it's consulting agreements or earnouts or equity that you keep in the business. In a lot of ways, you have a financial spouse for a period of time. So just like before you marry your spouse, you typically are going to ask fundamental questions like, what religion are we going to practice? Do we want to have children or not? It's really important that you take the time with a buyer to have those same type of questions with the business to understand where do they want to take it? What's the role that they expect for you to play? And so that you can really understand what your day-to-day life is going to look like. Because there's control at the high level, but a lot of times what people are really saying is, how is my day-to-day life going to change? Is this person going to be a pain in my ass? Are they going to be second guessing me all the time? And that's where it's really important to take that time to make sure that you've got that right fit. Because the reality is you're probably going to be financially successful one way or the other when you sell, but life's too short to deal with somebody that's not, the right partner for you.
Yeah, I think that's a great call out because a lot of times we'll meet with, contractors who are thinking about selling, and there's a large due diligence phase where they're looking at the numbers and whatnot. One thing that, and I don't know if you guys have seen this as well, is one thing as a seller, they're giving them the information while they're doing their due diligence. But I would say a big piece that I would urge sellers to look at is kind of doing your own due diligence into that. Like you said, David, asking those questions about the fit, about what their plans are, about what value they're going to add to it. Because I think as we've been getting into these conversations more, a big piece of, the private equity firms and the consolidators that we're working with, they use build ops as a value add. So as they're going through and we're going through the sale process, they're saying, hey, we are going to come in, we are going to help you guys get, best in class software for your portfolio companies. So I think, in your guys' opinion, is that a question that you should be asking? Like, hey, if all goes well, like what value are you guys going to bring to my business?
100%, because most transactions are going to have some type of reinvestment where you're going to have equity in the business going forward. So that's the equivalent of you receiving, a payout and then putting it all in one stock, right? So if you were going to do that, whether it's Apple or IBM or whatever it is, you would do your homework. And it's the same, I would say, you should do with your potential partner, right? What is their plans for the business? What are their capabilities? What are the systems and processes that they intend to put into play, both in terms of protecting your financial investment in this business, that combined equity that you have, but as well to determine, is this a good fit for you in terms of who you're going to be reporting to and what that day-to-day interaction is going to look like.
And I think that keeps supporting who you sell to really matters. And it's not just about the highest bidder. With $1 trillion of dry powder, maybe some of the newer, smaller players might be willing to overpay, and it might get enticing and tempting to maybe sell to the highest bidder. But fit, for the reasons David mentioned, because it could be a 1 to 3 year play, depending on your goals, you might end up having equity in the main company. Who you sell to becomes absolutely critical. And sifting through that becomes critical and a time-consuming thing. So keep that in mind as you're navigating the process, for sure.
We actually got a question from the chat. I thought it was a great question, so I'll pose this to you guys. They asked for you guys to explain kind of a few of the different PE approaches and transactional partnerships, being financial versus strategic, and how this fits for owners' goals and their long-term objectives.
I can take that if you'd like.
Absolutely.
So I mentioned earlier that basically almost every private equity firm in the HVAC space is pursuing the same consolidation strategy. So let me give you a little bit of context and terminology. So basically, in order to do consolidation and to aggregate lots of smaller HVAC companies, you functionally need a single larger one that has the systems, the team, the wherewithal to be able to go and systematically acquire and absorb other smaller acquisitions. That initial investment is called the platform, right? And that's basically like the Pac-Man that's going and absorbing the smaller ones that they get purchased. If you're a smaller HVAC company, in general, your option is essentially going to be only to sell to one of those platform businesses. However, if you're large enough, larger universe of potential buyers, you've got the entire universe of private equity firms. Currently, there's about 2,000 private equity firms in the middle market in the United States. And what that functionally also means is, as you get larger, as I mentioned before, larger companies tend to have a higher multiple than the smaller ones. It ends up becoming much more competitive. The reason being, if you're a small, very small HVAC business, your universe of buyers is essentially going to be people that are large with the financial means in your geographic area, more or less, right? As opposed to, if you have enough scale, then there's the opportunity where any private equity firm can look at your business, look at the business plan, the growth potential and all of that, and decide to back it. With those platform investments, there's the opportunity to stay on and essentially be a partner in that future growth, but allowing the private equity firm to essentially put all the capital to do that growth. Or sometimes there's a decision to transition to a professional manager. So all of those options are typically available, regardless of the approach. But what you'll find is most strategics that are aggressively buying HVAC companies today are in fact private equity backed. They just happen to be the platform.
Definitely. We actually got another question in the chat, and I think this one is a really crucial one because we see this on a lot of conversations. It says, David, you mentioned earnout. What were you referring to, and how does an earnout work? I think that would be good for everyone to understand.
Yeah, so earnout is basically, there's a portion of the purchase price that is essentially held back and gets paid based upon a contingency happening. Normally what that means is if certain levels of revenue or profitability are hit, additional purchase price payments will be made to, to the seller. And it typically is a way for a seller and buyer to span the gap where, the seller has more optimistic views of the future. And the buyer is going to say, well, I only really can look at the historical amount. And the way to come to agreement between both is to say, well, if next year you're able to hit that, and even the following year, we will give you additional payments to pay you as if your company was, of that size. The reality is that earnouts come in all shapes and sizes. They can have different lengths. They can have different triggers. But what really matters is it's a tool that is helping to incentivize for the seller to help maximize performance during the next stage of ownership.
Thank you so much for the questions. As we go through as well, anyone has any more questions, make sure to put them in the Q&A chat and we'll answer them live here. Now moving into our next section, I think a big piece that we want people to leave with is a little bit more confidence on how prepared they are and what things they could do. Tito, you mentioned earlier kind of things that they look at initially. But whether or not someone is necessarily thinking about selling, I think everyone can agree that they want, a stronger, more valuable business. What are some of the biggest things today that owners can start doing to increase their company's value?
I think when it comes to sale readiness, the accounting is a big piece of it too, right? Small businesses do a lot of tax planning, and that's common, and they can still sell with tax planning. But, we have a deal actually that we're working on where, and a lot of people do this, where they'll hold the invoices at the end of the year and then book them first week of January. And then suddenly it's the first quarter and they think they have a run rate of a very high number when really 70% of December's revenues were kind of booked to January. So I think just understanding the numbers, understanding their accuracy. When you sell the company, there has to be a shift to accrual accounting. For accountants, this is not the most complicated work. I think for the owners on this call, the important part is just having the awareness over the importance of that and how that might affect your numbers. In this industry, it's typically not a big impact, but either way, it has to be shifted to understand the ultimate valuation. I think that's a part that I want to touch up on there and share with the group. David, besides what we've talked about, right? New construction, install versus service, accounting, customer concentration is a big one that you want to address. If you have too much customer concentration, you definitely want to diversify prior to selling. Depending on many factors, probably too many to list now, strong management and kind of succession, I think, could be a key part of it. Basically, what I tell owners is if you went a month to Europe, do you have to field phone calls, or do you have the kind of company that doesn't need to call you? If the answer is I don't need to be called during that month, that's a really good sign, and it's going to be very attractive to a buyer. If you need to field 40 calls a day while you're in Europe, the company can still sell, but certainly that's going to be a little bit less attractive to the buyer. And I think that'll impact valuation for sure.
Yeah, they say, if you can't take a trip to Europe for a month, you don't have a business, you've got a job, right? And so, to Tito's point, having that bench that minimizes the key man risk, think about it from the buyer's perspective. They're going to spend a lot of money, and God forbid you get hit by a bus or you go off to the Bahamas. They want to make sure that the good money they invested in the business doesn't go to waste. And in particular, you got to think about that, these funds and these different investors, they're comprised of individuals, and there's no easier way to get fired than to write a big check and then, essentially have the value, evaporate. Another thing that I think is really important at the end of the day, this business and every business is really about the people, right? And so having a loyal, stable labor force I know is everybody's challenge, but that is a huge differentiator. There's some HVAC businesses that we encounter, and basically, the entire organization is new, relatively recently, and then you have others that essentially have been built over decades, and many of the individuals have been with the company for a substantial portion of that, and that the former is going to be much, much more marketable and command a higher value just because of the stability that it implies to the buyer.
Yeah, I think that's a great call out. When we speak with a lot of our contractors, I mean, people is the number one thing. I think at BuildOps we strive to make it the most friendly user experience for technicians, because at the end of the day, the technicians that are going out and doing that work on a daily basis, that is what all of the things that we're talking about are great. If you don't have that, that's the lifeblood of the company. So yeah, I think people is a really big call out, and kind of creating a winning culture. I know that you guys have, been a part of so many deals and whatnot. What do you think as far as like creating a winning culture at a company does for your help in selling as well as valuation?
Yeah, I think the biggest part is on the workforce stability. Um, in this particular industry, the exact number slips my mind, but the average length of employment was really low. It was so low, I'm questioning whether I should say it, but I mean it was 12 months or what, thereabouts. So when I meet a company whose average employment is 4 or 5 years on the technician side, I mean that crushes the valuation for sure. And it's not just valuation. David mentioned this, but I want to emphasize the word. It's marketability. So it's not just here's my company, here's what it can sell for. It's are the pieces that comprise of your company make it attractive enough so that many buyers want to get in on it. And the marketability is a huge part of it. And I think that's what culture really impacts more than anything. And it empowers the seller, because if the seller's got such a flawless company, culturally, financially, operationally, they're probably less inclined to want to sell it. So, it tips the scales back to them. If you're in Europe and you've got to get 50 calls a day, you're probably like, I probably should sell this company, right? And emotionally, you're probably in a place where you might be inclined to sell it. But if you can go away for that month, the culture's there and the operations are there, you've got the leverage.
And to piggyback off of that, when you think about marketability, implicitly, there's alternative options that they're considering, right? A lot of these consolidators, when we're having conversations with them, they're saying, hey, I'm looking at 10 at the same time, sometimes more, right? So a lot of what you're doing is essentially differentiating yourself relative to the competition. And to Tito's point, the goal when you sell is to sell from a position of strength on your terms, right? And so the more coveted and the more unique your business is relative to the rest, the greater leverage and the better terms and price you're going to be able to command.
Awesome. We also got a question in the chat here. They were asking, do either of you have any advice on how they can, help build that company culture, or any examples from, a prospective seller that was able to, help build their culture at their company?
I can jump in. Look, I think culture is super important. It's an intangible though, right? There's different data points like the labor force tenure and all that. But ultimately, what happens when a private equity buyer comes to the table is first they're going to look at it from an analytical standpoint, but then eventually they're going to go in and actually spend the time to understand the people, the culture, and all of that. And really, it's the qualitative aspects that determine how much they really want the business or not. And so from my perspective, there's no right or wrong culture. It's what needs to work for you and your business and specifically in your circumstances. But culture is really, from my perspective, what do people do when nobody else is looking, right? What is that default that people naturally gravitate towards? And so, how do you instill a culture? Obviously, there's dozens of books that were written about this, Peter Drucker and everybody else, but I think a lot of it is around um, uh, the behaviors and the experiences that you um, allow within your business, right? If you allow toxic behaviors within the company, that's going to impact the culture, right? It's not something that you can kind of turn on and off at will. It's something of which you need to live, entirely and consistently with. But going back, I don't think there's a right or wrong culture. I've seen some that are extremely high performance. They're only there to win championships, and they do great. But I've seen others where it's much more of a egalitarian kind of family-oriented atmosphere. They both can do well. I think what's important is that it's consistent, and that gets reinforced by who do you hire, how do you train them, what do you incentivize from a compensation standpoint, what do you incentivize in terms of praise and acknowledgement. Those are all the things that kind of build a reinforcing culture that generally when you talk about a buyer who comes in, they can get a pretty good sense of the feel of it relatively quickly, even though it's not something that's super defined like a number.
If I can add to that, just for the sake of trying to give some very more specific answers, or additional specific answers, I think something that doesn't get talked about enough in business is the importance of like masterful communication. So on someone's first day, can they go home that day crystal clear on what the expectations are, how it's going to be handled? It might take a few days, but if the first 72 hours of onboarding aren't at an extremely high level, the likelihood of success out of that employment is greatly diminished. Again, David references a bunch of studies out there. So communication about who, what, where, when, why is critical. Accountability to that is then critical. And then I think something that was maybe the hardest thing for me to do as I was maturing through my career is once you've identified all that and you've communicated the values of the company, do you have the HR process to match who you're hiring with the fit of the culture? And that becomes critical too. In some industries, you can't get that choosy, right? Because if you need the labor, you need the labor, and you kind of try to make it work. But to the extent that it's key personnel, in-house or internal, I should say, it's critical to have the right match between who you are as a company and a leader and those that you hire. You might have the communication perfect, but if you hire someone that's a mismatch, it's going to be clunky.
Yeah. Yeah, I think something that I've seen from build ops as well is being very solid on your company values as well is huge. And understanding the why behind them. I think build ops is very much so like keen in on, our values of, love your customers. And I think that kind of drives what you do as well. So yeah, I think those are great kind of examples from that. As we segue into kind of the final section where we're looking ahead and closing and whatnot, RC, can you throw up that final poll? This is just for you. I know there were several people that, are preparing to, look at a sale and whatnot. I would love to know kind of, if you guys would like any more information, we can have one-on-one conversations, whatever that might look like. But as that is up here, I'm curious as far as kind of your experience went with the sale of your business, Tito. After the process of selling in that transition, what changed and what stayed the same? Or even like what do you think could have gone better, could have gone smoother? Just curious your experience with that.
So the company I sold was in the payment space, and it had some dynamics that lent to simplicity post-sale. So I think maybe more valuable for the listeners and the viewers is on other deals that we've done, kind of, what have we seen that maybe made it a challenge? We talk about it a lot to clients, David and I. It's the emotional aspect of it. It's really, really hard to part ways with somebody, to something rather, that's a huge part of your identity. It's hard. And
Yeah.
we kind of seen the signs, right? If you go to sell your $2 million house and you say, well, this is so important to me, my kids grew up here, I only want 5 for it, then you're not really trying to sell it. Similarly, we have owners that are very emotionally attached to their business, and we say it might be worth 15, and they say, well, to me, it's worth 25. Go give it a shot. So they're not really trying to sell it, right? I think that's a huge part of post-sale peace, and just accepting the reality of the dynamics and just kind of taking a step back and looking at it as a vehicle as opposed to part of the identity. Those that can do that the most successfully, I think, are going to have the most post-sale peace, as opposed to the angst, which is very common, by the way. I forget the number, David, but we wrote an article about that. The number on post-sale regret is really, really high. So who you sell to is key. Would you deal with a little bit of angst for a lot of money? Of course. But 5 years of regret, it's not a comfortable place to be at, especially when a good process can eliminate that.
We're coming right up on time. Again, thank you guys so much for the conversation. I hope for everyone tuning in here that it's been beneficial for you, and would love to have more conversations with you guys in the future here. To kind of round it out, from both of you, I'm curious, just as we're leaving, what is kind of one thing, if the people on this call don't take anything away from this call, what is the one big takeaway that you would really preach to the people on this call here?
David, if you don't mind, I'll share really quick. I think
Okay.
educate yourself on the state of your company and the real world valuation of it. Why the industry has a lot of tailwinds. Hard to predict exactly what's going to happen, but I think the valuations are going to be healthy for the short term for sure. But this industry in particular has some very unique dynamic to it, and any industry with high valuations is going to be the same. If you have a construction company and you sell it and you get a 4x offer for it, 4 times EBITDA for it, most of those companies sell when the owners are older, right? Because 4 years is not a lot to sell it if you're 30 years old. What are you going to do next? But for HVAC, it's unique because I basically end almost every conversation with this. Do you rather work 6 to 9 months, which is roughly the sale process of your company, or somewhere in the 10 to 15 year range? And that actually tends to become the tit for tat kind of calculation that I like to leave people with. If you can sell your company for 8 times multiple or 10 times multiple or higher, depending on the size, you're going to have some tax savings there. So really selling it for 10x is kind of selling it for maybe 11 or 12x, depending on a couple of different factors. If you get paid that 6 to 9 months and just invested at 4%, you start doing the numbers and you've got to work roughly 15 years in the current state of your company to get the amount of money that you can get if you were to sell it in the next 9 months. That dynamic is really rare and kind of just wild in and of itself if you think about it, right? So I think if nothing else, whether you think emotionally or financially you're ready or not to sell it, just educate yourself on it, because that dynamic there, if that ever goes away, that's something that's kind of regretful to not have at least considered, even if they don't actually sell, just understanding where they're at so they can go home and say, okay, here's where I'm at with knowledge and peace, and then make a decision from there.
And from my vantage point, I think it's really important. Hey, don't don't hire us, but hire an expert M&A advisor to represent you. The reality is that the cold calls that people receive from private equity are there, and they spend the resources because they want to be able to buy cheaply. And the only way that you can get the best deal and have the confidence that you have the right fit is to run a competitive process and to engage with a lot of different potential buyers. And that's only going to occur through a professional advisor. And if you look at various studies, they show that in general, they're getting 25% more when they're being represented than when they're not. And probably the most compelling is that private equity themselves only sells with representation. So, choose whoever you want, educate yourself on it. But I think it'd be a big mistake to not try to have representation when you're dealing with a repeat professional buyer.
Awesome. Again, thank you guys so much. We will be sending out some resources and recording of this conversation. I believe those will come out tomorrow. But yeah, thank you so much all for your time. RC, anything from you?
No, I just enjoyed the conversations about bicycles, religion, and whatever else. Pac-Man, by the way. So appreciate that. The email that'll come out tomorrow will also have a link to an article that'll be basically the summary of this conversation as well. So you'll have that as a takeaway for you. You don't have to watch the entire video if you want to again. So we make it easy for you folks.
Appreciate you all. Thanks for having us.
I appreciate it.
Thank you guys.